Good day, everyone. Thank you for joining our interview with Michael Gentile, strategic mining investor and co-founder of Bastion Asset Management. This interview is informational only. It's not investment advice or a recommendation. Please talk with an investment advisor before making any decisions. Do your own due diligence and manage a well-diversified portfolio. It's your money, so take responsibility for it. As well, investing in resource companies, especially early stage ones, is highly risky. I'm Martin Gagel with Market Radius Research. I'm breaking up the interview into three segments. We're going to look at the overall macro perspective, and then general investment strategies and portfolio management, which I'm most interested in, how to manage risk and entry points and exits and so forth. And then we're going to talk about individual stocks and perspectives on that. And so with that, I welcome Michael. Thank you for joining us. Looks like you've had a very busy time in the markets this summer.
Yeah, great to be here, Martin. Absolutely.
All right. Firstly, can you give us a bit of a background on yourself, Bastion Asset Management, and the investing? We had a little pre-discussion on this. Who invests where and what, and how does all that work?
Sure. So quick 25 years and 2-minute summary. I've been investing in institutional equities markets since I was 16 years old. Got my first job in institutional equities business when I was in my early 20s. Worked for 18 years at an institutional money management firm in Montreal. So I was running a hedge fund, market neutral hedge fund, one of the largest market neutral hedge funds in Canada with my partner, Charles Hager, from 2012 to 2018. Doing really well, loving my job. And then in 2018, I had twin daughters and I had 3 girls before that. So I had 5 girls under 8 years old looking me in the eyes. Was traveling like crazy, needed to take a time out. Back then, telecommuting, working from home, Zoom didn't exist. And so it was very much a physical intensive business to be in the office, 60, 70 hours a week. So made a hard decision to walk away from the career I'd built up for 18 years. I had covered commodities my whole life since university, literally covering commodities, investing in commodity stocks, covered commodities at my previous firm. And so in 2018, I was at home with 5 beautiful girls, had some capital to allocate, and I was very, very bullish on gold at the time. Gold was 1350, had risen from 1100, was still very depressed. Sector was on its knees after a brutal kind of 7-year bear market from the last bull market. And so I started investing in micro cap companies. I said, if gold price is going to go up a lot, which is my view at the time, and it's been proven correct, I said, where is the sector that has the most torque or most leverage to that call, which would be junior precious metal equities. And so I had not done that professionally. I was investing at Formula Growth, my old institutional firm, stocks between 200 million and sort of 10 billion market cap. So mainly producing assets or very close to producing assets. But because it was my own capital, I had a bit of time on my hands. So I'm going to get maximum torque by buying junior Explorco. So I invested in a couple of companies, 2018, 2019 timeframe. Was going to be passive in that approach because I thought I was going to return back to institutional business at some point in time. And as I invested in these companies, Martin, I realized, one, they were incredibly undervalued. And the opportunity set was just much larger than I thought because it had been a 6-7 year bear market. So I was able to buy companies that had made a discovery in the last cycle, had no money for 5 or 6 years, were sitting with a proven discovery that looked like it had real legs and real potential and at a 5, 10 million, $50 million market cap. So I did one, I did two, got really fascinated by the opportunity. But what I also saw, Martin, was these companies in general were quite poorly managed. And there was the real issue that I saw was most of these companies were being managed by people that were either geologists or scientifically minded individuals who didn't really know how to raise money, how to get the right kind of shareholders, when to raise money, who to raise money from, how to do acquisitions, how to market the company, how to communicate your message to investors. They would just drill, raise money, drill, raise money, and then the outcome for shareholders in most cases was pretty poor. So I realized by going from passive to kind of rolling up my sleeves and adding some sweat equity to the equation, that I could add even more value. So I became kind of a cornerstone investor, kind of 5 to 20% shareholdings in some of these companies, and then lent my 18 years of experience of hearing 10,000 investment pitches over my life, kind of turning the tables and helping these companies communicate their stories better and knowing which pools of capital were really quality cornerstone shareholders and which ones were more renting the stocks for the warrants or for a tax break in the case of flow through investing. So I felt that as soon as I started doing that, there was not only a value add from my investment, which is well timed at a good point in the cycle, but also the value add resulted in really strong value creation. So instead of going to 2, fast forward 7 years, I'm now the largest shareholder personally in about 25 junior mining companies where I'm a top 1, 2, or 3 shareholder. I'm on 6 boards, and all the other ones I'm not on the boards. I'm heavily involved in the strategy and the stewardship of those investments because I typically take a 5 to 20% stake when I'm involved. So I want to be a very active and very involved and very supportive shareholder. And just to finish the loop, 3 years ago, I told my wife 4 years ago that I'm like, when I first quit my job, I'm going to be so miserable that I'm, going to be a pretty miserable guy because I love what I do. I have to walk. I know I have to do the right thing, get away from the business and spend time with the family, but I'm going to be a pretty bad, miserable guy. Just bear with me. I was having so much fun doing junior mining investing. I told my wife 4 years ago that I'm like, I'm never going back to the institutional business because I'm having so much fun doing this junior mining investing, and it really fit my personality and my skill profile. And then my 2 former partners who I loved working with in my old shop called me up and said, "Hey, we're quitting. We're starting a new firm. Would you like to get the band back together?" And it was literally an offer I couldn't say no to. It was the only 2 guys in the world that could have called me and said, "Do you want to get back in the business?" And I would not have said no to. So we started Bastion Asset Management about 3.5 years ago. And that is institutional equities, like 200 million to 10 million, 10 billion market cap companies, all sectors, long, short. We have obviously a significant weight to commodities because we're both, my partner and I, Charles, who runs the fund, are quite bullish on commodities, but it's a generalist fund. So I get a lot of calls saying, "Can I put money in your metals and mining fund?" I don't have a metals and mining fund. I have my own personal capital invested in the juniors, and then I have an institutional quality firm that invests in, the mid cap companies like a K92 Mining or a Equinox Gold, that kind of approach, along with healthcare companies and tech and industrials across the spectrum. So I have 2 hats that I wear, but it allows me to cover from a 10 million market cap junior all the way up to potentially Newmont in terms of investment opportunities. So it gives me a really good view of the whole industry from biggest to smallest. And I have a pool of capital, whether it be my own capital or institutional clients' capital, depending on the risk appropriateness of the investment to allocate in all those areas of the market. So it gives me a really nice perspective and allows me to be in touch with the entire market opportunity.
So when we see a news release or that you have invested in a company, this is your personal account. This isn't the hedge fund doing it.
No,
This is you.
this is me. When you see Michael Gentile making an investment in Junior XYZ, it's my own personal capital. I mean, Mark, we've talked about this before, like the risk reward is very interesting in the junior mining space, but the volatility of returns is so high. They're illiquid stocks, so they're not really suitable for a pension plan or a high net worth individual who wants to, make 10, 15% a year and be able to sell his investment on Monday and buy it on Tuesday, and vice versa, right? So the institutional equities are the more liquid, mainstream owned producers and other sectors. Whenever you see my name around a junior, it's my own personal capital. We designed it that way on purpose because I don't want to have any competition with my institutional clients, right? So the Bastion Asset Management has a certain market cap and up, and that's why I focus in on the really small end of the market cap because there's no ability or desire for Bastion to buy those stocks. We're not conflicting with each other. There's no conflict of interest in that way.
And as well, like, I don't know if a lot of people appreciate how running personal money is actually quite different than running other people's money. A lot of different incentives. You can take a much longer perspective on it. As well, if people are pulling money out of your fund, you may be forced to sell and liquidate some things. Hopefully, you're not in a position where you're forced to sell stuff, but you can be a little more nimble and take a different kind of perspective than a traditional portfolio manager would.
That's a great question, Martin, and a great point. People don't appreciate the pressure that portfolio managers are under to deliver, monthly, quarterly, and annual returns. So since I built a pretty good name for myself in the junior mining space, you can imagine I get a lot of phone calls saying, "Can you run my money? Would you start a fund?" And I know what that's like. I know I could do it. And I'm, in all humility, I know I could do a pretty good job at it. But the ability that the advantage that running my own money gives me is that I have no one to answer to except myself and my wife if she looks over my shoulder and sees how we're doing on our portfolio. So in that sense, I can take on a longer time horizon investments. Like to give you an example, from 2018 to 2020, it was a pretty robust market. We did really well. And then, my portfolio is probably down from the peak of COVID till the lows a year and a half ago, probably by 45, 50%. Now, if you're running after being up 200-300% on the way up, right? But if you're running a broadly distributed fund, what ends up happening is investors often sell at the absolute wrong times. So they're throwing money at you when your fund's up 300%. And when the fund's down 50% and there's maximum opportunity to be allocating more capital, they're pulling money out. So not only do you don't have not money to invest in new names, you're forced to sell names that you're selling for 5 cents on the dollar in terms of real fair value to fund those redemptions. And so my time horizon when I invest, we're going to get to it a bit later, but my time horizon is kind of 3 to 10 years, more likely 5 to 10 years in terms of when I make my first investment to when I expect to realize liquidity. So that gives me an amazing advantage. As fun as it is to see my portfolio up like it is the last 6 months, or as painful as it is to see it be down 40, 50% post-COVID, they're just marks. They're just pieces of paper and a screenshot, right? So for me, the real value is created over that 5, 10 years. Where's my portfolio gone? How much value have I created? And I don't have to worry about reporting returns to investors, explaining why we're down or up. It gives me a lot of
Angry phone calls from
yeah.
big institutions and so forth.
If you look at Warren Buffett, why he was so successful, obviously he's a brilliant investor, but his fund is basically a closed-end fund. Like he doesn't ever had a redemption his whole life, right? You buy Berkshire Hathaway on the stock market, you sell his shares, it doesn't change the amount of capital Warren Buffett has to allocate. So he's able to buy with three hands when the market's down and sell when the market's up, and he has no outside pressure from investors who can dictate when he has to buy and when he has to sell. So there's a different mindset that comes with running someone else's money, and with the volatility in the junior space, you really, if I ever did that in the future, you really have to have investors to understand this is a 5 to 10 year allocation and the month-to-month marks. Just close your eyes and don't look really, and don't get too excited things they're good, because it'll cause you to make the wrong decisions time and time again.
All right. I was going to rearrange, talk this in a different way, but since we're talking about some strategies and issues as you manage your own money, can you talk about when you're investing in new companies, what are the key attributes on generally that you're looking for? Like there's good ground, but I always talk about management is everything. Management can find a new project, or they can destroy an existing good project. What are you looking for in balancing management with existing assets?
Yeah, I'd say so. When I came into investing in the junior Explorco sector in 2018, I had the advantage of investing in more senior companies for 20 plus years in the commodity space. So what I did say, how am I going to do this properly? And I had to because I'm an institutional minded investor, kind of a systematic approach. I didn't want it just to be speculation or throwing darts against the dartboard. I want to have a systematic approach to allocate capital. I started with, okay, so what does a success look like for a junior Explorco? And a junior Explorco, the maximum success you can have is finding a discovery that goes into production. That is your sort of, if you're in that business, unless you're just a promoter trying to sell stocks, you want to see a company make a discovery and go all the way into production. That's how you make 50, 100, 200 times your money on an initial investment if you get in early enough. So having invested in producers for 20 years, I tried to reverse engineer what are the attributes of a producing mine and layer that over a junior exploration company or a resource company as early on in the process as possible. So what are things that make a mine? What are things that end up killing a mine from becoming a mine? And so I kind of got a bit of a checklist that I go through. It's simplistic look, but there's obviously more to it, but it kind of very simply grade. So the higher the grade you have, that's your margin. So that means you're going to be more profitable in lower commodity price environments. You got to have the scale. So you can have grade, but if you don't have enough material to justify the capital you have to put into the mine, it's not going to work. So the combination of grade and scale give you the payback or the cash flow over a certain number of years to justify the infrastructure that has to go in to build a mine. My third one, sequencing logically here, infrastructure. If there is no infrastructure in an area, then tack on $1 billion or more for roads, power, hydro, airport, all things that are not there. If you have existing infrastructure in an area, then logically speaking, you need less grade and less scale to justify the investment. So we're thinking, how many ounces or how many pounds of copper do I need to justify the infrastructure? If the infrastructure is already there, it's by default a lower number. Fourth point would be jurisdiction, right? So is it, and I don't want to say Canada good, Africa bad. I want to talk about in this area of Canada, in this area of Africa, is it possible to build a mine? Is there government support? Is the local community support there? Where is the taxation and the stability of law in that country? So in terms of jurisdiction, is it a place where we could potentially build a mine one day without too much opposition? Another one I look at is economic efficiency or return on drilling dollars. I know how to kind of say it in a more elegant way, but I look at drill cost per meter. And so if I want to grow a deposit, a lot of investors don't look at this, right? But if your drill costs are $1,000 a meter, versus some of my projects in Quebec and Ontario that have $200 per meter drill costs, right? That means for every dollar you put in the ground, you're getting 5 meters in a low cost area versus 1 meter in the other area. Doesn't mean it's not a good project, but it means if you're spending $1,000 a meter, you better be looking for something that is extremely large and extremely valuable, because that's going to add up over time, especially as the juniors that face dilution. You got to find some heck of a holes or heck of a deposit to keep justifying putting $1,000 a meter in to give you a payback on those exploration dollars versus projects that have lower costs. And then finally, you mentioned management. every management team that's ever come on your platform, Martin, or ever met, always tell you they're good. This is the best management team. We got the best management team. So the way to cut through the crap in that would be one, a network. So I have a network of people that I really learned to trust the last 25 years that I know the industry very well, that have a lot of contacts. I always check people out through my network. And if I know someone that I trust who knows the management team, that's also a good safeguard against bad behavior. But the biggest governor of good behavior, Martin, I think, is insider ownership at the management and the board level. Because if your management team and your board owns 25, 30% of the shares, they're owners now, they're not renters. So if things go wrong, the market goes south, you're going to cut G&A like crazy. You're going to try to preserve shareholder dollars. You're going to work really hard to get that permit because you own a lot of equity. If you don't own equity and things get a bit tough, maybe you raise money on terrible terms just to pay your salary. Worse, maybe you throw in the towel and just walk away and try to start something new or go into the Bitcoin or marijuana space like some guys did before. So ownership at the board level means incentivized sweat equity. So I'm involved in a bunch of boards. I take very little to no salary. Any situation I'm involved in doesn't matter to me. It's not material, but I put a lot of hours into the project because I own equity. And my return is going to be if the company does well, my shares are going to increase in value. In these junior mining companies, you have two, three, maybe full-time employees, and you have 6 or 7 board members. If your board all owns a bunch of stock and are heavily engaged, it's like having 6 or 7 extra employees basically for free that are driving the value of the company, bringing their experience to the table because they want to see the value of the investment increase. So that's something that's extremely important to me. And if I don't see that, I get nervous. And I also like seeing management that writes checks. It's okay to get, found a company and have some equity from founding, but I also want to see them, if they can, financially participate in subsequent rounds, put their money where their mouth is so they are on the same level and the same, tolerance of risk for investors that are asking to invest alongside their company.
Where do you, when you see drill results or that, do you have enough technical expertise and where you assess that yourself, or do you hire a consulting geologist or just some of your geologist buddies you send information to? How do you manage that real technical risk?
Yeah, it's a great question. So my first mentor in my early 20s who founded the investment company that I worked at gave me a great lesson I'll never forget. He said, Michael, you want to surround yourself with people that are way smarter than you. And a lot of people in this business don't do that, Martin, because it's a pretty competitive business and they like to be AAA type personalities and they want to be the smartest guy or girl in the room. But that lesson has served me very well, especially in a geology kind of resource sector where I'm not a geologist. So I would say I know enough to be dangerous. I have, spent 25 years looking at these things. I can kind of sniff out what looks like an economic hole or an economic deposit or economic geology versus non-economic geology. But at the same time, I still make a lot of mistakes. So what I've done is follow that advice, built a network of, geologists, metallurgists, mine builders, people that I trust that like to co-invest on my deals. They know that I look at a high volume of potential investment opportunities. I looked at 2 or 3 of them today, even before this call, Martin. So I'm doing a lot of calls with junior mining companies, potential investments. When I find one that says, this one could really looks interesting, I like the valuation, I like the setup, it goes through my checklist of things I look for. That's when I will make a call. I don't use those calls now, so I don't want to call my network every single project I look at, but out of 20 projects I look at, maybe one really gets me excited. Then I'll check it through my network. If it's an exploration story, I'll ask my geologist that I trust to look at it. If it's a production restart or a mine build situation, I'll ask mine builders that I know, say, okay, look at their assumptions for mining costs, for throughput, for processing costs, for the capex going to the project. Is this wildly optimistic or realistic? And so if it comes back, and oftentimes they get a failing grade. They go like Michael, good instincts, but here are the 3 or 4 reasons geologically this thing's never going to scale, or this PA is not worth the paper it's written on. It's way too aggressive in terms of cost, and it's going to be twice the cost to build this thing, and it kills the project. But that keeps me out of trouble. That just increases my odds or my hit rate of making a good investment. So that's very, very important to me. It's the network effect. I like investing with similar-minded investors also as well. So when I invest in deals, I love having a partnership with people that are going to put in, let's say, 5 million on a deal, and they're doing their own due diligence and they're doing their own channel checks. So it allows you to come to a better decision with that group intelligence that you have versus saying, I know everything, I can do everything on my own and I'm going to make right decisions every single time. It's not realistic, especially if you're looking at the volume of deals that I'm looking at.
Not well, do you invest in, let's say, pre-discovery exploration plays where it's just you like management and it's generally in a good territory and that, or what, like, do they have to have a discovery hole for you to get involved in?
Really interesting question. So I like to operate along the Lassonde curve. And so,
Yeah.
my perfect setup, Martin, is what I had in 2018 and what I've had basically the last 6, 7 years, which I've been so aggressively deploying capital in this space, which is I have a situation where people are very pessimistic on a commodity in particular. In this case, it was gold in this case, where I have a very bullish view. So the market's negative, I'm positive. If the market's negative, that's typically reflected in the valuations of the companies along the Lassonde curve. And so what happened in 2018, I was going in after a 7 year bear market. And so typically in a more optimistic market, the valuations of most companies from pre-discovery to discovery to PEA to pre-feasibility are at a certain level. But in 2018, everything was trading at like 10% of its normal value. So the companies I was buying in 2018 is I can go take greenfield exploration risk and put money into the ground, put $5 million in the ground, try to make a new discovery. Or for a $5 million market cap on the public market, I can walk in and buy companies already discovered 500,000 to 1 million ounces, open in all directions, no money to do a single follow-up hole because the market's been shut for financing the last 5 years. So in that case, for the majority of the last 6 years, I have not done a lot of greenfield exploration because my next step on the Lassonde curve is post-discovery. And normally in a normally functioning market, you make a discovery, your market cap goes from 10 million to, let's say, 100 million. But these companies were still trading at 10, 12, 7, 8, $9 million market cap. So why take the exploration risk where you have a 1 in maybe 50 chance of making a commercial discovery when you can pick off what I felt were many of them potentially commercial deposits that were just starved of capital. So I've been very much focused on that. The market's just started to turn the last 3 to 5 months. We started to see some life in the junior market. So I've started to plant a few seeds with a couple of geos that I really respect. We're thinking about starting a private company, looking at picking up some exploration lands, early stage kind of grassroots targets, well vetted, in the anticipation that the opportunity to pick off projects that have existing resources and quality projects at low valuations will be gone by this time next year. Like the market will start to lift. And at that point in time, if you're trying to buy an existing discovery with 1 million ounces in the ground for a 500 million market cap, then maybe it makes sense to put in money in a earlier stage. It's all a relative, for me, risk reward discussion about how much money am I putting in? What does the next company up on the Lassonde curve look like? Right. So part of the reason why the developers are trading better now is because the producers finally got a bit of a multiple now. If you can buy a producing asset that has 200,000 ounces a year production, it's only got a 500 million market cap. Well, how can a developer that has a 200,000 ounce 1 day producing company have a big market cap when its big brother producing asset doesn't trade well in the market? Well, that asset now has a 3 billion market cap, so there's now valuation room for that less developed company to grow into and have investors say, okay, well, when I grow up or when I achieve production, I'll trade like Equinox or B2 Gold. They have a better valuation, so they can now see a pathway to good return. So it's all this relative valuation and what's available in the market vis-a-vis the cost of capital today.
And I just want to make a point. When you're investing, you're strategic. You're not just buying shares in the market. You're investing, putting capital onto their balance sheet. So if you're just a Joe investor buying 10,000 shares of something, but they're undercapitalized, maybe it's cheap, but if they need to raise capital, then it could get worse. You're actually affecting change in the companies you're investing in, which is very different than just buying a few thousand shares in the market.
Correct. One thing investors need to be aware of if you're allocating individual capital is major overhangs on these stocks as they all consume capital. They all burn through cash as a regular course of business. They don't generate cash flow. So if their company is underfunded or the market knows there's a need of funds, typically the stock will start to drift lower until that problem is resolved. And so, yes, at the size that I'm buying, Martin, if I'm trying to buy 5 to 20% of a company, very hard to do that in the market, nor would it be advisable to do that in a business where people consume capital for a living. So I typically come in under private placements. So what my investment signals, hopefully the market is, I've done my work, I've done my due diligence, doesn't guarantee success. Bringing in typically a high quality cornerstone group of shareholders and solving that capital overhang for the moment in terms of the market now can say, okay, the company is well financed, they can move forward on their projects, and they have an investor here who's going to think like an owner and defend against dilution or bad financing decisions. They're not done badly on purpose, but just sometimes desperate times cause desperate measures. If there's no capital available and you don't have creative solutions, sometimes companies choose the path of least resistance and raise money from less desirable shareholders that end up causing trouble. So yes, I'm 95% of the time coming in on private placements. I will add in the open market if I make an investment and the fundamentals are getting better, the stock is below my price and the company doesn't need money, I can add to my position in the open market. But in general, for my chunky investments, it's on private placements.
I just want to circle back to your marketing activities. You are going on a European roadshow in October, and I believe you're bringing some of your investee companies with you, sort of marketing them. And I guess that's another value you add to the companies you invest in, why you're probably a very attractive shareholder to have on the books as you help bring awareness and so forth. Can you talk about your European roadshow, maybe what companies you're bringing with you and what you're hoping to accomplish there?
Yeah, the idea came out of a few of my companies were in Europe, and since I had my twin daughters 6.5 years ago, have not traveled that much. I've really restricted my travel. So many of my companies have been to Europe, and people know I'm a cornerstone investor in some of those companies, and I often get asked, when's Michael going to come to Europe? When he's going to talk about his investment approach? So we created a roadshow around that idea where I'll be explaining my investment process. How I allocate a bit what we're doing today, but a little more detail, how I allocate capital, what I look for in investments, how I've attacked investing in junior resource mining, as a profession, let's say the last 7 years. So there'll be a teach-in on, what I look for, how I allocate capital, the attributes of a winning junior mining investment in my view. And I'm a former university teacher. I taught at night for 10 years at university. Nothing better when you're teaching students on how to invest money to bring some real live examples with you. And so instead of just talking about the hallmarks of good investments in junior mining space, I brought 6 of my largest current dollar investments with me on the road. Doesn't mean I don't love the other 25. I mean, I love some more, some less in the 25 stock portfolio, but the idea was bring my 6 largest dollar value investments where I'm an insider or have a heavy shareholder in those companies and allow them to present to the European audience their story so people can hear from me as to what I look for and then hear in real live flesh and bone what these companies are, what the attributes are, the opportunity they have going forward, and the quality of the team behind it. So it's lunch session from 12 to 2 o'clock. So 2 hours, they'll hear me and 6 companies, very efficient use of their time. And there'll be one-on-ones in the morning with me and some of the other companies, and then a cocktail at night just to have more time for networking and socializing. So it'll be a nice condensed one-day trip, 5 cities, London, Paris, Geneva, Zurich, and Frankfurt, October 6th to 10th. And yeah, for your European audience would be great to see some of those investors there and get to know them face to face.
Okay, great. And if they do want to get additional information, you can send me an email and I'll forward things off to Michael. As well, with Peter Grandich, you're doing a live event in New Jersey in November. Why don't you tell us a bit about that?
Yeah, so for your viewers that don't live in Europe and don't want to save the cost of a flight going over the pond to see my companies and me there, I'm doing a one-off event November 8th. It's a charity event with Peter Grandich. We're raising money for a disadvantaged community service organization. And it's going to be November 8th, Saturday in New Jersey. I'll be giving a 2-hour talk and answering questions over the 2 hours of investors have on the markets, commodities, and my investment approach. So if you're interested in that, we'll put a link in the show notes as well. The European tour is free. It's sign up only. We have to get approved to come, but we can just register and you can get an invite from the organizers. The New Jersey show, it's $250. I'm not making any money from this. All the money is going to charity. Only 40 spots available, so it'll be a very intimate gathering. Both myself and Peter will be available for about 5-6 hours there to answer any investor questions on investing in the junior resource sector.
You switching back to the markets themselves, you said when you first started investing, 7-8 years ago, things were really cheap and things are starting to heat up. How do you view the junior markets now? Are they hot, overvalued? Is it a little dispersed? Some are a little too much. So there's still a lot of missed stories. Generally speaking, as concrete as you can be, how are the junior markets faring right now?
So it's been amazing. As I mentioned, I'm doing this for 25 years more, and I've never seen a setup like this before. And so what I mean by that is I'm very comfortable and done it many times. I invested in oil and gas in 1998, 99 when oil was $10 a barrel. People said it's going to go to 5. It was super negative, and oil went to 145, $145 a barrel. So I'm very comfortable investing in that blood in the streets, pessimism reigns type point of the cycle, especially when I have a contrary positive view for the commodities I mentioned earlier. What's happened in gold is it was very pessimistic 2015 to 2018, not a lot of interest. So started making investments there. What's happened is the gold price, as is close to tripled in value since then. But the junior resource stocks for the greater part of the last 6 years, as gold has been rising pretty much every single year, have not at all risen, which is very unusual. Usually when a commodity makes a new high and breaks out to new all-time levels, the stocks follow. So there's been this major kind of pent-up energy, I would say. These gold stocks have been suppressed for 4 or 5 years. Most of the junior mining stocks that I own in my portfolio today, many of them are still trading below their COVID highs, despite gold being up, $1,600 or more above its old previous high. So while the recent rally feels good, right? It's been nice to see these stocks, it's made them double the last kind of 3 to 4 months. On a contextual basis, there's still a lot of room to run. And I'll give you two guideposts. GDXJ, which is the mid cap producer index, was $160, $170 a share, the last high between 2008 and 2012. Today it's around 80 something. So it's still 50% off its old all-time high. And a very good friend of mine in Montreal, Yves Soho, who does some good work in Quebec, macro kind of minded guy, he sent me an email today saying that, in average gold cycles, the junior resource sector trades at about 10% of the value of the gold price in the ground for an ounce. So you go back to the 1990s when gold was $300 an ounce, the average resource in the ground traded at $30. If you go to 2008 to 2012, when gold price hit 2000, the average resource was trading about $200 in the ground for value. Well, today we're $3,600 an ounce. And the average resource is trading around from $20 to $120 per ounce in the ground on average for most junior resource companies I follow. So we're still 3 to 10 times below the average in situ value. So the gold price going up has dramatically increased the value of the gold in the ground. And so far, the only companies benefiting from that are the producers who are seeing massive increases to cash flow. And just in the last 6 months, the large cap, the Barricks, the Newmonts, the Agnicos of the world, and some of the bigger mid-cap names, IM Golds, are starting to make new 52-week highs, some cases new all-time highs. So they're starting to see their valuations increase because the value of their gold production is going up. But the junior resource market is still very, very depressed in my view. It's still extremely undervalued in my view, still seeing incredible opportunities to allocate more capital. But it's the first 3-4 months where I've finally felt the wind a little bit at our back. And it's been such a long winter, so to speak. It feels good. And you might say, oh boy, it's getting a bit overdone. But when you put that in a context, we're just getting started, in my view, of a multi-year rally in especially the smaller precious metals companies. Not saying we can't have a 10, 15, 20% pullback. It's perfectly normal on a rally, but we still feel very early. To use a baseball analogy, maybe second or third inning, right? But the crowd's starting to get into the stadium and it's starting to get going a bit, but it's still very early. I don't see Uber drivers or CNBC or mainline portfolio managers saying, I'm loading up on junior resource stocks, but it's starting to warm up a little bit, and that's very positive because when these rallies go, they can last for quite a few years once the wind gets going at their backs.
What I've noticed as the difference is when a company does get some good results is they actually get a bit of a bid on the stock it runs. Like a bunch of years ago, just nothing would happen. No one would care. If anything, the stocks would go down because, oh, great, I can sell on some liquidity now.
Yeah.
But now we're getting a bid and it's running up. But I don't see anything that's really getting too crazy out there. It's the markets still seem like they can get really wound up still. There's a lot of room for that. On the macro side, and boy, we're chewing through our time, but this is a great interview. The big macro S&P 500 do you have a lot of concern of a big macro crash, debt crisis, black swan stuff, or just, hey, we could hit a little bit of a correction, which would be normal and healthy? Because when the big corrections do happen, liquidity gets sucked out of the junior markets. Doesn't matter how good it is. Kind of everyone gets crushed on that side. It goes to the liquid stuff. Big perspectives, risk of a big crash or just a pullback, or what do you think?
It's a good point for your investors to remember. So when the market pulls back, say NASDAQ or S&P 500 has a major sell-off, it would actually be quite positive for the junior resource and the mining gold sector in general. We have not seen yet, Martin, in this rally, which typically kicks off or accelerates any major rally in the metals markets and the mining market equities, is a major market pullback. And what that does is capital rotation. The gold sector is extremely small. I don't know what the latest stats are, but the entire mining sector in the world is like a quarter of NVIDIA's market cap or less, right? So you could sell 1/4 of NVIDIA and buy almost every single mining company in the world, just to give you an idea of how small this sector is relative to the overall market pool of capital, which is actually extremely bullish. when you think about the strategic importance of gold reasserting itself, it's always been, but as a monetary metal, gold crossed over treasuries in terms of foreign central bank ownership for the first time in 60 years recently. So the central banks are clearly saying gold is the new reserve asset of choice versus the US dollar. That's a mega trend. And so you think about the importance of gold and the importance of all these critical metals like copper and silver and zinc and tin and lead, all these metals for the EV transition and for fueling AI and electrification of the grid. These are two crucial sectors that have a very microscopic percentage of overall capital invested. So what would happen in a crash would be you stop making easy money in tech, you stop making easy money in S&P 500. All portfolio managers like myself run a generalist fund for most of my career. We'll go, where am I going to make money sustainably for the next 3 to 5 years? And so when capital comes out of one sector, it'll flow into the next best looking sector. And I think gold and metal mining, copper, and those are the best next place to go. So we've had this rally despite people not selling their tech shares this piece. So if we have a pullback, that'd be a major pause where capital get reallocated to the sector. But in the short term, there's still stocks. So when you have a soft in the market, people are needing liquidity, they're getting margin calls, they'll sell anything. So you'll have a drawdown in these names like we saw during COVID. But my view would be they would be the first to rally and the most explosive to rally. And actually, that would be very positive for the long term. In terms of market crashes, my partner Charles Hager, who runs the fund every day at Bash, is probably better to answer that. But I would say one thing I'd point out to your investors that we're thinking about a lot of is the market rallying because fundamentals are good, or is the market rallying because paper money is worth less and less and less? So if you look at the performance of the S&P in gold over the last 12 months, it's actually down quite a bit. So we're trying to differentiate how much of this rally is fundamentally positive and how much of it is people saying, the US dollar is getting less and less valuable. Fiat currencies are less and less valuable. So I've got to park my paper bills in something that can protect me from inflation. And so stocks are a decent inflation hedge for that. Gold's a really good one. And so I think we got to look through that in a period of massive money printing and devaluation of paper currencies. Like Argentina's stock market made new all-time highs every single year for the last 15 years because their currency was devaluing at 80% a year. So nominal highs versus real is an important thing we need to start looking at more and more and be aware that maybe you're not as rich as you think because the 1 unit of the S&P 500 buys you a lot less than it did 2 years ago, even though it's up. So you got to think about it more inflation adjusted dollars or purchasing power dollars. And I don't believe the CPI numbers. If you look at what's costing you to live your life and things you actually need, it's not 2-3% a year. Stuff you actually need to survive is up 10, 20, 30% a year in dollars that actually cost you money. And so we need to become more and more aware of that. I think it's also fueling into the narrative of hard assets are going to gain more and more prominence, like they have in all countries that have had currency devaluations, that all the residents of those countries really understand the value of purchasing power preservation.
It sure sounds like you think that gold commodity itself has legs to it and it's still room to run.
I think there's a mega trend of central banks, the BRIC nations, allocating away from the US dollar into hard dollar assets like gold. So I think that is a mega trend. Most of the rally we've seen in gold market has really been driven by central bank buying. It's not been the typical buyers, which has been the investing public and the large macro funds and the hedge funds that buy gold, which is also very bullish as well. Like the GDX and GDXJ have had negative inflows for all of last year. Only turned positive this year, despite gold going up $1,000 now. So it tells you hasn't gone mainstream. And so when the central banks are not, I'm buying gold in 2024 and I'm selling it in 2026, they have a target for a percent of their balance sheet to be allocated to gold, and they're persistent buyers over time until they reach that target. So that to me is a mega trend. What I have been saying, Martin, over the last 6 months is that the equities are a lot more attractive than the gold price. We don't need the gold price to go any higher to have a phenomenal kind of 3 to 5 year run in these stocks. I think the trend is your friend. It's going to continue to go higher, but we don't need gold to go to 5,000 to 6,000 to have these stocks go up 2, 3, 400%, some of them, right? If gold can just go sideways for a few years, I think the backdrop is there that it should go higher. You're still going to have an incredible runway of investment in this sector. But the central bank demand is huge because it's less whimsical, less trading oriented, and more just structural. And that we haven't had in the gold market since the 70s.
All right. I've got a theory that one of the reasons that the speculative mining companies haven't had that big pop is that there are other speculative ways for investors to play now, be it Bitcoin or digital stuff, or even sports betting. So many of my kids' friends are like addicted to betting, and like any extra speculative capital is going to betting on the Bulls or the whatever. Any thoughts on that as to dilution in the speculative market to other assets or other
Yeah,
uses of
so
capital?
this environment reminds me a lot of the late 1990s, Martin, the dot-com boom that we had, right? Remember back
Yeah,
then, people were saying old economy stocks, railroads were worthless, banks were worthless,
yeah,
money names were worthless because it was all old economy. The only thing that really had value was .com. And guess what? All those people are right. Internet ended up being 20 times bigger than they dreamed of back then. But the
yeah,
Nasdaq went down 80%. And all those old economy stocks that were ignored for years ended up being the best performing stocks for a decade after that. So AI is a mega trend right now. AI is going to be huge, but the valuation of AI, the amount of money flowing into AI, you're right that if you can make 500% by getting a couple of software engineers together and doing an AI startup, putting a PowerPoint deck together and getting funded from Silicon Valley and get a $100 million valuation a year later with a business plan and a couple of really smart programmers behind you, why don't you do that? Same thing happened to dot-com boom. A bunch of guys got together. I'm starting a dot-com and I'm overnight, I'm worth $1 billion or $100 million. So that is a lot of speculative money is going there. It's easy to make money in AI right now. It's easy to make money in the Magnificent Seven. It's easy to make money in crypto and some of these other speculative things, but they are highly speculative. And from my experience, when a lot of money is pouring into a sector like AI is right now, the overall long-term return on all the investment going into AI is likely to be very, very low because you're over-capitalizing it, you're over-investing in it, and there's going to be
yeah,
very few winners. There'll be an Amazon, there'll be a Facebook, there'll be a Google, and there'll be 99 companies that earn their investors zero for that investment, right? And so,
yeah,
once that the air comes out of that balloon, and it will, right? That speculative money will have to find a new home, right? And you'll
yeah.
get some of those investors back into the gold space that has great long-term fundamentals and provides probably a little the entry points and the valuation of these companies are a lot more attractive than buying an AI startup at a $7 billion valuation or a $30 billion valuation like you're seeing in the market today. So that'll be the next wave of investment. What's nice is that we're rallying even without that. We're getting the
Yeah.
tailwinds, but it'll be future pools of capital. Portfolio manager capital we talked about, speculative capital. That hasn't come into the sector. That'll what will be fuels the next rally. When all that capital is in and everybody's allocated to gold, it's probably a sign that we're getting close to a top. But to me, we're still several years away and multiple billions and tens of billions of dollars away from that allocation wise.
We're quickly running out of time here. What are your favorite commodities? Sounds like gold's in there, copper. I don't know. Pick. What are some of your favorite commodities?
Yeah, I'd say gold and copper in that order. We didn't get to too much about how I pick investments. I'm really focused on finding companies that have potential to be a mine. So I'd rather buy a commodity where I'm neutral to slightly positive on that has an asset that could be all the attributes of a potential mine one day than buying a gold stock that I quickly ascertained that's never going to become a mine. So I'm not someone who's going to just buy a gold stock because I'm positive on gold, but my commodity backdrop does inform what percent of my capital and how many opportunities I'll invest in each sector. But I think gold and copper are quite constructive over the long term for different reasons that I'm quite pleased to invest in. And then there's other commodities that I'm, positive to neutral on. Some commodities like oil, I think has a nice long-term picture, but not now. But it could be something if it gets negative enough, I could allocate to that. And some of the more, exotic metals like zinc and some of these bulk commodity metals that are in the base metal space are also interesting over time because we're going to need a big build out of all of these materials to fund the revolutions we're trying to do in these countries. And I don't feel like we're anywhere close to the capital and the permitting to make that happen. So there should be a high pressure effect on pricing on all these commodities going forward due to the lack of supply that's going to be able to be brought online.
Quickly, we're not going to get through a major amount of the companies that were listed. Why don't you just highlight the five companies, I believe it is, that you're taking with you to Europe on your roadshow? Those are the biggest positions, I believe, or some of the biggest positions you have, just to see, presumably you're the most bullish on these stories and exemplify your investing strategy.
Yeah, and just to save time and get to a few of the questions you had from viewers, I will just do them really quickly, like 30 seconds. So I'd say, North Isle Copper and Gold is a, premier development project in BC, all-star management team with two mining Hall of Famers on the board. Probably one of the best looking PEAs development projects I've seen in a while. It's got about a 400 million market cap, but the net present value at spot pricing is close to $5 billion. Just getting on the radar screen of a premier gold, copper development project, great infrastructure, power, roads, airport, everything's in place, port, with really exciting exploration upside. So that's one. Northern Superior controls 4 million ounces in the Chape-Chibougamau camp, 12 million ounces in the camp, was a highly fragmented camp 5 years ago. North Superior, my partner and I, Simon Marcotte, who runs the company, CEO, has done the heavy lifting to consolidate, 5 or 6 junior mining companies into one. So now these 12 million ounces are owned by two companies, IAMGOLD and ourselves. We think the camp has potential to be 15 to 20 million ounces or more in Canada. That's an extremely valuable proposition. Still trading at sub $50 Canadian ounce in the ground. That's a very attractive package and likely to be developed project over time where we have a commanding position there. Radisson Mining, high-grade gold, Abitibi, Hualien, Cadillac Larder Fault, 1,000,005 ounces today at very good grade between 5 and 10 grams. 6 mills, Martin, within 75 kilometers of the project. So great infrastructure, power, a lot of hungry mills in the area. And the recent exploration success that we've had there is pointing to 3 to 5 million ounces of potential. Company's got 16 million cash in the bank, 60,000 meter drill program ongoing right now. So lots of news flow. A really robust PEA we put out with a sub 2 year payback recently. So showing the value of infrastructure in the area. And it's not well owned by institutions yet. So that's one of the advantages of going on the road, starting to introduce these stories to the larger pools of capital that can see the potential for these projects to become mines. Group 11 Resources, I think they've been on your platform before, Martin. 50 million tons of zinc owned by Glencore and Group 11 in the camp. 8 to 10% zinc, which is just on the margins of economic development. My thesis there was always if we could find 5 to 10 million tons of high grade, 10 to 20% zinc, that would make this whole camp light up and be extremely valuable. Good news for shareholders is we think we found that at the Ballywire deposit, 1.5 kilometers of strike, 10 to 50 meter wide zones of massive sulfide, 10 to 20% zinc, lead, silver deposit, great continuity. And the real exciting sizzle is below that. We think we've tapped into very juicy copper silver system of like as high as 6% copper, 1,000 grams per ton silver, some of the highest grades ever seen in Ireland. So we'd have a layer of zinc, lead, and silver, and then a layer below that of copper, silver, very high grade. This play keeps playing out. The whole camp becomes extremely valuable for a major to want developed. Still has a paltry kind of $80 to $90 million market cap. Great management team, low drill costs, all things I look for. Last two, Capitan Silver. Silver stocks in general are a little more expensive, Martin. They're hard to find quality, pure play silver stories that have good management teams. Capitan Silver, Mexican-based management team. Top 7 shareholders own 70%. During the downturn, they kept the share count tight. They consolidated the entire district. They increased their land position by like 200-300% during the downturn. And now they're putting out results of 2,500 gram per ton silver over 3-4 meters, 400 gram silver over 20 meters. Really nice hits. It's an intermediate epithermal system. And what that means is they're very rare. They have depth potential of 400 to 800 meters deep. A lot of these silver systems are high grade, but very limited in vertical continuity. This is like a Mag Silver, a Gato Silver, a Fruta del Norte, very rare geological systems. They have a Conster plan. They have Jupiter Fund Management and myself as top shareholders. The company's just starting to drill again after consolidating the camp. Did a great acquisition. And unlike other silver stories, Martin, this is like 95% silver they're drilling in these holes. They're not silver equivalent holes that have 80% zinc and other stuff and a little bit of silver. And they're quoting it silver. This is pure silver they're drilling, which is extremely valuable and extremely rare. The last one is, I think Astra has also been on your platform, Astra Exploration, very high grade gold and silver in Argentina. Management owns 15% of the company. Never seen this before, Martin. During the downturn, just to preserve cash, the company didn't pay themselves any salary for 11 months. VP Exploration, CEO, they went to zero salary. This is not IOU or deferred. It was just, we're not taking salary. We're preserving dollars. They took that money, went out, did a fantastic acquisition in Argentina where they saw super high grades. The previous operator didn't see the geological model to have real scale. They came in, Diego, their head geologist, did an amazing job working up the targets, realizing, wow, this thing has real size potential. The last drill program they did, all the holes they hit were step outs, everything hit 8,000 gram per ton silver, 70 gram gold in true step out holes. Just press release this week that they're going back out to drill in 2-3 weeks there. fully funded for phase two program, still only has a $40 million market cap, and it's one of the most prolific districts in Argentina. 50% of the gold and silver of Argentina has been produced in this corridor. So great infrastructure again, great location, and an asset that looks has real legs. And again, 60, 70% owned by a few cornerstone investors, really supportive shareholder base there.
Given out of a lot of demand for information on Arizona metals. A lot of questions. Are you still a shareholder there? What do you think the prospects are? Take it away on Arizona metals.
Sure. I've publicly been a very large shareholder, still am a shareholder of the company. It's been full transparency, been disappointing because the company had some phenomenal drill results for the last 3, 4 years, talking about 100 meters at 3 grams gold or 100 meters at 3% copper, like really impressive intercepts. Love the location, great infrastructure, Arizona, made in the USA, copper or gold target. Like a lot of attributes of the project, huge exploration upside there. The previous management team didn't do a good job of keeping expectations in check. They were, talking about a 25 to 40 million ton resource potential size. New management team came in, again, didn't do a great job of managing expectations there as well. They came out with a 10 million ton resource at 3% copper, so really nice grade, good continuity in that deposit. But the size obviously was quite a step down from the previous kind of 25 to 40 million tons and 15 to 25 million tons down to 10. So there's been a series of step downs in the size of the resource. I think current management could have done a better job articulating to management post the resource that we're just getting started. Only about 10% of the trend has been drilled. There's a lot of upside potential here. Where you find high-grade VMS deposits, you typically find more of them. But there's been a bit of I think, weakness in communication of the upside. So we had a disappointing resource, probably a poorly explained upside potential. So that's why the stock is down where it is. Company is well financed. They had about $25 million on their last published balance sheet, 100 million or so market cap Canadian. It's about a quarter of the market cap in cash. So they're fully financed to drill more at K. They also have a historical gold project called Sugarloaf that has a 1.5 million ounce oxide gold resource. So they're going to be drilling in Q4. So there's a lot of things to like here, Martin. I'd like to see management buy some stock, and get more aggressive with the stock having pulled back from, $7 to 75 cents. I'd like to see management get a lot more aggressive buying stock. I'd like to see them get a bit more proactive at telling their story in a more forceful way. But it remains an investment for me. I'm not an advisor. I'm not a board member. I don't have a hand on the steering wheel there. So, limited in the involvement I can have in the company, but definitely at these levels, it feels like a really good value. Understanding it's been a disappointing ride for myself and others in this story. That's why I have a portfolio of companies. They don't all work at the same time, but it's definitely one that I am remaining very actively involved with in terms of following the story and looking for tangible signs of progress there. But on a valuation perspective, especially with the move we've had in the market, feels like a pretty good risk reward. But I'd like to see management be a bit more forceful in articulating that and defending that publicly.
Was it strictly poor setting of expectations, or like you said, the resource estimate was a little disappointing as well? Was it like on an absolute basis, or just on expectations wise? And if it didn't have the expectations history, this could be exciting. Or was there actual some of the results just not
Yeah,
great?
I think expectations were probably, if the expectations had been 5 million tons going in and the stock had never been $7, it probably would have rallied on the back of the resource. But part of being a management team in a public company is understanding where are the expectations of the market, right? What are people
Yeah.
expecting, and how do I manage those expectations and get people in line with what the reality is going to be? And as you know, it's not an arrow at anybody here, but like junior mining investing, expectations get out of hand very, very quickly. As you drill
Yeah.
big holes, people get really excited and throw big numbers out there. And so as a management team, you got to constantly be if you want to have a long-term success, tempering those expectations to what you think is reality. And then if you do have a disappointing resource, I think you need to communicate to investors that how this thing can grow beyond that. 10 million tons at 3% is a really good starting point for an economic project. But laying the investors the roadmap to how that 10 million can become 20 or 30 million tons over time as you explore more the upside potential puts a little bit of balm on the wound, so to speak, of the disappointment. So there's ways to manage that, but the fact remains, good project. I mean, the management team is technically competent. They built many mines before in their careers. So it's not their first rodeo, but I think it's a case of expectation just getting too out of whack. Emotions, like we talked about earlier, right? Like just in terms of just your just because the stock is up, it's not a good company. Because the stock is down, it's not a bad company, right? You have to separate that emotion from reality. And I think there's still a nice opportunity ahead for Arizona Metals.
Okay, thank you. I believe we're out of time. You've got to jump on a phone call here shortly. Unfortunately, we didn't get around to a lot of the names. Maybe we can get you back, maybe after your road trip or something, and we can be less macro and more hit on a few company names.
Sure.
Thank you very much for taking your time. I thought it was fascinating, excellent perspective you have on the markets. I really appreciate it. Any final comments?
No, just to say, for those that ask questions and have time, happy to come back for maybe just an exclusive Q&A session. If you want to do that next time, we can answer as many questions as we like. Or if not, come and see me live in person on one of my tours. I'd love to meet your investors face to face.
Michael, thank you. And the audience, thank you for attending and great questions you had. I'm sorry we couldn't get to many of them. Thank you very much.
Thanks, Martin.
Cheers.